My name is Hillary Ripley. I'm a senior director at First Center Investors, where I represent the direct infrastructure division, Igneo Infrastructure Partners. Igneo invests in infrastructure opportunities in OECD countries. We've been investing on behalf of institutional investors for about 30 years, and we focus in particular on middle market opportunities and platform build-outs. Today we have about $18 billion under management, and that is invested in a combination of renewables, transportation and logistics, digital assets, and other businesses related to sustainability. I personally have been working, speaking with institutional investors for about 2 decades, primarily direct infrastructure investors. To the extent that markets came under exceptional pressure last year, I've spent the last few months speaking with those investors and their advisors about how they are thinking about their infrastructure investments and portfolios in the context of their wider portfolios. We've all been talking about the denominator effect for a little while now, and it remains an important factor in people's planning. But there are very few investors I speak with, at least, who would say that it is the only or even most important factor in the current slowdown in activity. 2 other important factors that the folks have been wanting to discuss are a concern around current valuations, and a second or third, a concern about a problem that I'll call proceeds indigestion. So with respect to valuations, the spotlight is currently trained on equity risk premia that managers use to value their existing and prospective investments. A question that I receive pretty routinely is, Hillary, how is it that real estate investments could have fallen so precipitously in 2022, while direct infrastructure investments, for the most part, held pretty steady? A really good question. I mean, some might say, well, that infrastructure investments are designed to do that. Their revenue composition is meant to pass through inflation in their pricing, and therefore they should hold steady. But the counter argument to that is the discount rates that are used to value these investments should be somewhat sensitive to interest rates. And it's for that reason surprising to many observers that there wasn't more of an adjustment with the 10 raises in the Fed fund rates last year. Some investors I speak with are actually actively researching real-time discount rates associated with active transactions, or they're trying to, with the thought that that could be really used to substantiate or test current valuations if you were to try to collect real-time discount rates sector by sector and risk class by risk class. The problem is that those underwriting details are very difficult to source. As for proceeds indigestion, the concern there is around broad slowdown in GP distributions. Normal economic times, as GPs manage their portfolios and those individual investments throw off cash, or as individual investments are exited, GPs will distribute proceeds with some regularity. In this particular moment, that evidently has slowed down considerably. And that has led to an unforeseen liquidity problem at the LP level. That then leads to LPs to either slow down or cut back their reinvestments with managers, and therefore the fundraising cycle for many GPs has weakened. Under circumstances like these, right, the questions around the denominator effect or what that will lead to, questions around valuations, proceeds indigestion, A lot of state systems and other public and private investors chose to pause toward the end of last year and beginning this year to determine whether the allocation priorities that they had set prior to 2022 still made sense post the interest rate rising environment last year. Many LPs, in fact, took that opportunity to revisit their asset allocation and deployment schedules over the first half of this year, either formally or informally. So those challenges paint an imposing picture, right? But there are still a lot of observers of this market and participants in this market who I've spoken with who have stepped away from the initial sort of longer estimates of how long this pause in activity might last. Originally, when this first quarter fundraising sort of hit a wall, a lot of people were estimating that might be as much as 12 to 18 months before some of these questions were resolved. I'm now hearing some folks say that they actually think that there might be a pickup in the second half, which would be fantastic. Whether or not that happens, there remain a couple of reasons that people are citing for long-term optimism. So first, we remain in the early innings of what many would call the largest secular economic cycle of this generation. And things are changing pretty quickly in this generation. We now have generative AI, and people may rephrase that, but at the moment, many people will contextualize the global energy transition as the largest cycle that we've seen in many decades. Even in the face of what might be persistent inflation, like 3 to 4% inflation, and even in the face of once-in-a-generation change in working patterns that was driven by the global pandemic, it's still difficult to imagine that the market dislocation that occurred last year could really be enough to swamp the long-term impact of the energy transition. So, by way of example, in Australia alone, which is one of the countries that we invest in, installed capacity needs to double between now and 2030 for that country to reach its net zero targets. It then needs to double again by 2040 and a third time by 2050 to meet the subsequent targets. All of that together has been estimated to amount to about $400 billion in capital, and that has not been raised, let alone deployed yet. This really is the early innings of a transition, despite the amount of capital that's been raised and put to work so far. Many people believe that there for that reason alone, there will be continued pull on the demand side. Most of the PMs I speak with about the energy transition, they continue researching some very important unknowns as they look at the opportunity. They want to look at, for example, development and interconnectivity and the timing of those two activities. They want to look at the technical trajectory of battery storage, the regulatory support and the implementation of the tax credits, which also, really early days in the US in terms of the actual impact that will have. And then the revenue composition of the assets once they're brought online, right? So those are all huge, important unknowns. But even with all of that, there remains little question that the global economic system is developing ways, both public and private sources of capital, to develop that capacity. The second important reason for optimism that folks like to cite is historical market patterns. And put very simply, these questions around valuations are going to get resolved one way or another, right? It will occur transaction by transaction and sector by sector. New portfolio allocations targets will get set as that resolution occurs. There's very likely to be an increase in risk appetite as that happens, and we're already seeing some of that. As interest rates increase and inflation increases, you're going to see an increase in the targets that are set for direct infrastructure. But all of that aside, the long-term low-vol returns that so many portfolio managers target for their infrastructure portfolios are going to remain the characteristics of the portfolios that infrastructure managers design. So add to that the fact that there remains this tremendous amount of capital that still needs to be deployed, and the empirical market patterns that have led a lot of people to remain optimistic. With that, I want to thank IREI for giving me the opportunity to share these sort of collected observations. I look forward to discussing some of them further with some of you at one of the upcoming roundtables. Thank you.